Crazy. But oh well, let's get going with today's work. So today is chilled in terms of our approach because we have lost some time. So what I want is for us to actually just oh, am I sharing my screen? Oh, I am. Okay, because this wouldn't pop up. What I want is for us to just go through the questions, and then I'll show you how I recommend you answer such questions. But then you should be able to. I will also supply this for learning unit 6, so that way you can obviously then just practice. Because I think the way the textbook also does it sometimes. Yeah, you see things like that as well. And I think also the structure, the flow in which they've, particularly this 6.1, could be done in an easier, more a comprehensive way of, just a better flow for your mind, should I say. But anyway, enough talking. Let's get into it. So question 6.1. Under the required, they are asking 3 things there. They say, number 1, calculate the after-tax cash flow associated with the lease and the buy alternatives. Okay. Then it says calculate the present value of each alternative using the after-tax cost of debt. Then finally they say, should the company lease or buy the manufacturing equipment? Give reasons for your answer. Okay. All right. Now let's see what's happening in this question to give us more context. A sofa company is trying to decide whether to lease or buy manufacturing equipment. Okay. The company could lease the manufacturing equipment directly from the supplier for annual lease payments of 30,000 payable in arrears. Okay. The lease term is 4 years, and the company will have the option to purchase the manufacturing equipment on termination of the lease at a cost of 10,000. The financial manager intends on exercising the option. The lessor is responsible for the maintenance and insurance costs of the manufacturing equipment. Now, alternatively, the company could finance the 100,000 cost of the manufacturing equipment by taking out a 4-year bank loan, okay? Charging interest at 14% per annum with installments of 34,320.48 cents, payable annually in arrears. Why are they telling you in arrears? What is the relevance of that? Because in arrears is basically telling you at the end of the month, isn't it? Instead of at the beginning of the month.
The beginning. To know who's putting at the beginning of the month or the end of the month.
Yes, that's exactly it. You need to know, is this at the beginning of the month or the end of the month? Because as you know, once you throw in those amounts in your calculator, if it's at the beginning of the month, it's going to be significantly different. Your final output or your final answer will be significantly different if it is at the beginning of the month as opposed to at the end. Okay. So that's why they're informing you about that. Okay. But let's go on. The company is responsible for the maintenance and insurance of the manufacturing equipment at a cost of 2,000 per annum. So here you can see it's not just about having enough money to buy, all right, the machine. It's also about the maintenance costs associated or that come with the machine if we are to buy. The company would be entitled to capital allowance deductions of 40% in the year of purchase and 20% in the following 3 years. Okay, so quite a lot to consider here. Assume that a tax rate of 28% applies. The deductible tax cash flows relating to the lease and buy decision arises in the year it accrues. All right. And the company has sufficient taxable income against which to apply the tax deductions. Okay, so you know sometimes the challenge is you cannot, you are entitled, let me say it like this, you are entitled to a tax deduction, but you don't have sufficient income to actually apply it. So what do? You roll it over to the next year. Ah, but you guys are tax professionals, isn't? So you know this. I'm right. Okay. The company's after tax cost of debt is 10%. All right, and we need that for our what's this lease option. Lease option. In fact, for both to calculate the present value of these cash flows. So how do we then approach this question? So the first thing they asked us there, let me zoom in. Calculate the after-tax cash flows associated with the lease and buy alternatives. In other words, how much money would be leaving us to fund either option, okay? So first thing, with the lease, what expenses are coming off? It's literally just the lease payment that we need to worry about. There's no maintenance, okay? And we know of that payment, we can claim tax because it's an expense, okay? So isn't that going to reduce our taxable income, okay? So we can apply 28% of whatever expense we're going to pay. We know every year we're paying 30,000 at the end of that, of each year, sorry. So, and then there's the 28% tax, and that's where your 8.4 is coming from. And that's why it's not in brackets, it's a positive, so that's obviously money for us. It's going to reduce this 30,000 expense. And that's why you see your after-tax cash flows, all right? Money leaving us, since it's in brackets, 21,600, okay? Now, what we need to be mindful of is the 10,000 at the end. Remember, they said at the end, we have that option to buy the equipment. And they said the financial manager, which is us, intends to take advantage of that, okay? So just be mindful, because in another question, they might say, but the financial manager does not intend to, because the equipment will be obsolete. So just be mindful of that, okay? There's obviously going to be a mark or two there. And obviously, if we get this 31,600 wrong, what does that mean? Our cash flows calculation in the next portion of the question is going to be wrong, okay? We're going to arrive at the right amount. But anyway, the lease option, pretty straightforward. We now come to the buy alternative, okay? And here you are pretty much doing the same thing, but now we're just considering different, well, all the costs associated to the buy alternative. So firstly, we have the installment, okay? What did they say? Did they tell us how much? Yes, they told us how much the installment is. So that's a copy and paste. Then we know the maintenance cost. They also gave us that, okay? But they haven't given us the tax shield, right? Which will then help us to finally get the after-tax cash flows, okay? So what we then have to do, first things first. So the first thing that I advise that you do, yes, you need to do an amortization schedule, okay? But now my question to you is, did you guys do any amortization schedules in accounting? Okay, so you're comfortable with that. And did you use your calculator to do that? Excellent. Okay, because I don't advise wasting time doing the whole structure here, okay? Because yeah, you might waste time, but make sure that you get this right. But it's not tough, isn't it? To do your amortization schedule. It's only if you make a mistake with your inputs that this is gonna go south, but then you should be okay. So you throw your amortization schedule in there, okay? We know the principal, we know the installments, right? And then obviously it's gonna work out the interests that we're paying every year, and it's also gonna work out the balance of, but you guys know this, okay? Right, so we have that. Then when, yes? How we do it? the steps are the tables. So you cannot complete this after-tax cash flows of the buy option because we don't have the tax shield. So you can do, let me start using my, because what you're asking is very important. So when the first one is pretty straightforward because it's just, we are given this, isn't it? This we need to calculate, right? After we've calculated that, we know to get our after-tax cash flow is literally just the difference between those two amounts. And then obviously this we were also given, isn't? So this one is fine. You're happy there. That one would be your first step. Then we move to the second one. This row, you know, this row you're given. Both of those you're given. This one we are not given. So we can't work out the after-tax cash flows until we have the tax shield. Makes sense? Yes. What do you input into your calculators? That's what I was hoping you guys knew from your, because our calculators are different also. But it's on YouTube. So I would advise, please go onto YouTube. And which calculator are you using? Are you using the HP? Yeah. Okay. Yeah, just go onto YouTube and say how to do amortization schedule HP calculator. Yeah, so, and then specify which HP calculator you have. Then it will show you how to do this. Okay, right. Then once you have your amortization schedule, and it's good for you to watch the full video because it will also show you how to navigate to see your closing balance, to see your interest, to see your installment. Okay. And what you'll see is it will also basically show you, okay, if we're paying 14,000 in interest in year one, and our installment that we paid is 34, then how much of that is capital that is being paid off? Does that make sense? Here we're just showing you how your balance has decreased from 100,000 to 79,000. Can you see that? But we don't have a column that is showing you how much capital has your loan actually decreased. Does that make sense? Okay, so it's good if you make sure to understand that as well. Okay, right. So once you then have that, now we say, okay, we now need to calculate our tax shield. Okay, our tax shield. So we say our interest for each year, copy and paste from the amortization schedule. And then we know we have our maintenance costs, which we know we can also deduct on tax. Then they told us that we have a tax allowance deduction, 40% in the first year. So here we're saying 40% of the 100,000 and then 20% in the following 3 years. And that's where we're getting these 20,000s from together so far. Okay, so our total tax deductible expense, we're adding these three amounts, and that's how we're arriving at this 56,000 and so on and so forth. Now, once you then have that, you then say this after-tax cash flows, you want to then calculate for me quickly, because I didn't check this. It should be 28% of the 56,000. Even is correct? 0.28 times 56. Yes. Okay, I'm getting the 15,600. Okay. So once you then have that, can you see that's money that we are now basically getting? Can you see we made it as a positive there? Okay, now we can calculate the total after tax cash flow that we are paying for this option. All right, which is obviously 20,640 in the first year and 27,037 Rand and 4 cents in year two. Are we good so far? So the purpose of the first question was to arrive at this point, to get your after-tax cash flows for both options. Okay? Once you have that, you have completed the first question. You now move to the second part of the question. Okay? And then they say, calculate the present value of each alternative using the after-tax cost of debt. So in other words, get the MPV. Okay, so I've put this table here just for you guys to see, but I don't want you to use this. Okay, right? Because you guys have, a lecturer used to call them Ferraris in your hand. Okay. You have very powerful machines. Okay. So now you obviously enter in your cash flows, enter in your interest rate, you get your NPV. This calculation, I know you guys know. Okay. And then you should get the following amounts. So already you can see which alternative is more expensive for us. The buy alternative, because it's higher. Okay. Right. So just from looking at that, which alternative are we going to go with? We should go with the lease. Okay. So here, let's see what they're saying in point 3. They say the company should lease the manufacturing equipment because it is the least cost alternative. In present value terms, the company would save 6,594.76 cents if it leased the equipment rather than buying it. Now, guys, very, very important. They could manipulate this question to say, what if the seller is willing to pay the maintenance? Can you see how that also would affect your cash flows? Okay, so just be mindful of those small little tweaks, because that's the way they can obviously manipulate the question. There was one other thing I wanted to mention. Yes, this is why I highlighted this. Guys, a lot of you will be perfectly fine with this, with getting those values, right? You remember we're doing finance here. Wherever you have numbers that add value to the justification of whatever decision you have, throw it in there to say you will save so much, you will lose so much if you went with this option. Does that make sense? Okay. It just is a good look. Mm-hmm. Yes.
I was under the impression the higher is the better, because like it's more value. But now in this case, it's because we're spending this, so the higher is the more we're spending.
When we say the higher the better, is that a positive value or a negative value? Positive value. Yeah. And you pretty much answered yourself. Because when we have a positive value, that means money coming. Yeah, money coming in. That's money that we've made.
Oh.
So you see, it's a bigger negative value. Money leaving us. Okay. Right. Okay. So that is your 6.1. Yeah. I'll erase that stuff before sharing it with you guys. So we now come to 6.2. 6.2. Oh, is my watch? It's been off this whole time. So 6.2 is pretty straightforward. But I don't know. I didn't see them give you guys this year. They didn't give you guys the formulas for calculating the value of an option. All right. So here, I'm gonna leave this with the slides. But just to quickly unpack this. So remember, for you to hold an option, right, or to have an option, you need to pay a premium. Once you've paid a premium, then you now own the option. Okay, right. Now, remember, option gives you the right, but not the obligation. So here, we want to calculate, should I utilize or not utilize the option? So ST stands for the market spot price. In other words, the price of the share price at the time that you're calculating the value of the option. Okay. So for a call option, what we want is we want the price of the MTN share to be higher, right, than the price at which we can buy that. Okay. So the spot price in the market should be higher than K. K is the strike price, the price that our option allows us to buy the MTN share. Okay. So here we're basically saying, if the value, the maximum value of S and T, the difference there, is greater than 0, then there is value in this option, and we will execute the option, or we will what instructs to the writer to deliver on the option. That's what we mean when we say max and then brackets ST minus K, which is a strike, and then comma 0. If the value is greater than 0, we will execute. If not, we will not. Okay, right. And then just to quickly explain, for a put, it's the opposite. Remember, a put gives you the right to sell. Okay, so here, what we want is our strike price, the price at which we can sell by way of our option. It should be higher than the selling price of the MTN share in the market. Okay, so we are basically saying, in fact, I basically explained. Okay, so there's nothing more to share there. The max, again, it must be greater than 0 for us to execute. Otherwise, there's no money there. It's not valuable. The option is not valuable to us at the moment. Okay, so here now you can see at the bottom summary table, and there you can see exercise condition. For a call option, you want the spot price, ST is the spot price, to be greater than the strike price, and vice versa for your put option. Okay, so I just thought, so you don't have to go to the examples and then try and make sense of what they're doing there. Okay, so here now, they give us some scenarios. You have been presented with the following schedule of options held by your company, each involving 150 share options, 150 share options. Okay, right. So they tell you the cost. So you paid a premium of 550, and then your strike, in other words, the price at which we can buy is 35 Rand. The underlying share price at expiration. So these are European options, because European options you can only execute at the end. American, you can execute at any given point in time. Okay. Yes. You didn't know. It's nice when you pay school fees. You learn something. Okay. So now we then say, let's apply our formula. Okay. So we then say, okay, the spot price is 30. The strike price is 35. So can you see that here we're not going to execute anything? Because what's happening? The price in the market is less than the price that we can buy at. So think about it practically speaking. You have bought an option to buy this bottle at 10 Rand. You've already spent 5 Rand to buy that option, isn't it? To buy this at 10 Rand. But Pick n Pay is selling it at 8 Rand. Are you going to buy the bottle for me for 10 Rand, or are you going to go and buy it at 8 Rand from Pick n Pay? 8 Rand from Pick n Pay. Okay. There's no value in this. This is when we say this option is out of the money. So here, can you see we've written, I'm going to highlight it, 550 loss. Why? Because we spent the premium for the option. So we're accepting we're not going to execute. So we're accepting we've lost our money on buying this option. And here you can see in the comment, it says the option should not be exercised because there's no value in it. Okay. The loss is limited to the cost of the option. If we did choose to exercise, knowing what we already know, okay, so say that's a negative 5 rand already times 150. What do you get? Negative 750 and then minus 550. So can you see your loss is now 1.3? Is it better to have a loss of 550 or a loss of 1.3? You see, so this is why you say, it's okay. Let me just accept I've lost my money. Okay, right. Anyway, Yebo. The 150 is the number of shares. Because, yes, the number of shares. Because remember, in the formula I gave you, you might find in one exercise, they might give you 1,000 shares. Another exercise, 500. Here, they've given us 150. So I just gave you a formula based on calculating if there's any value. But yeah, hasn't included that, the number of shares, sorry. Right. So with the second one, this time it's a put option. So this time we're saying the strike minus the spot price. So here, 75 Rand is what? Is our strike, and 65 Rand is our spot price. So already you can see there's a 10 Rand profit on each share. So 10 Rand times 150 gives you 1,500, isn't it? 1,500 minus the sorry, I'm looking at the wrong one. 1,500 minus the 625 Rand we spent on the premium to buy this option. We've got a gain, can you see, of 800. So is this option valuable? Is it in the money? It's in the money. We're going to exercise the option. Okay. Right. And then we go on to another call option. So you can see this exercise is really not tough at all. Once you get understand the formula, understand when you are executing on a put and when you're executing on a call, and when you're not, then you should be fine. But let's just do the third one and then we will call it for this exercise. So we have another call option. This time it's costing us 250, and we see that the strike price per share is 65 and the underlying is 70. Just from looking at that, are we going to execute or not? The strike is 65 and the spot price, the price currently, or let me not say currently, or the price at expiration is 70. In other words, the price in the market for this share is it higher or lower than the price at which we can execute or exercise our option? Is it lower?
50.
Yes. So what is lower? The strike is lower, which gives us the right to do what? To buy at a cheaper or higher price? 100%. Okay. So the strike price is lower. The market price or the spot price is higher. We together? Okay. So are we going to execute? Yeah. We're going to buy these shares? Yes. Because it's cheaper than what it's currently selling for. So there you can see 70 minus the 65, 5 Rand times the 1,500 minus the 250, we make a gain of 500. Okay, the option should be exercised. Anybody got any questions here before I move on?
What's the Does it matter if it's a call or put option? Like, does the formula?
It does. Because the formula is actually opposite. Uh-huh.
Is it strike price minus market price?
With a put option, it is strike price minus market price, yes. Because we're saying, remember, we are selling. Whenever, think about it from a business perspective, whenever you are selling something, you want the highest price on your product, because that means more profit for you, okay? So we're saying in the market, you can only sell, this is just a random example, you can only sell for 8 Rand. But our option has allowed us to sell for 10. That's a favorable situation. Okay. That's a favorable situation. Okay. So again, I'm just going to show you the formulas there just so you can also have a look. There you can literally see your put option is K minus, it's actually too low. Sorry. Then it's now K. Right, there we go. For your put option, it's K minus your spot price. In other words, your strike minus your spot price. The price we can exercise at minus the market price. On your call option, you've got your market price minus the exercise price or the strike, should I say. Okay, so that's fine. That is your 6.2. 6.2. This one is pretty straightforward, but I think I can see it's 1 minute to our break. So I think let's take our break. And then after our break, we'll proceed with 6.3. I think we'll get to 6.6 before the end of today. And then next time I see you 6.8 and 6.7. And then we will also probably do the theory to learning unit 7. Yeah, so that on Tuesday, we'll see how far we get to learning unit 7. So that the last week, maybe we can do a paper or 2. So, okay, right.